I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower. And I think that we're still holding our breath because we're in a period where the Fed isn't going to make an interest rate decision until September. So some of the key macro is kind of on hold. So I think markets are wait and see, but I'd say that pullbacks have been shallow. I think that's everyone's playbook, that August should be weak and September down. But precisely for that reason, with the economy being stronger than people realize, Bitcoin made a breakaway move on July 9th. It has led the S&P for the last 5 years by almost 1 month. I think our year-end target is probably low, because I think we could do 6,600 this month. I think this is the month.
This month?
Yeah, I think we're going to have a breakaway move in the S&P this month.
Bitcoin's steady momentum into August suggests its rally may just be beginning, with enough strength to potentially pull the S&P higher as well. That's according to Tom Lee, co-founder and CIO of Fundstrat Capital. Lee points to the shallow pullbacks since April's lows and Bitcoin's decisive breakout in July as clear signs of resilience in the market. Historically, Bitcoin has tended to lead the S&P by about a month, and this setup looks strikingly similar. With August trading conditions still thin and many investors expecting weakness, Lee believes the stage is set for an unexpected upside move. If Bitcoin continues on its current growth path, it could boost broader market sentiment and spark an S&P breakout ahead of the Fed's September decision. Still paying taxes on your crypto gains? What if you didn't have to? With ITrust Capital, you can buy and sell crypto inside a tax-advantaged IRA, giving you a smarter way to grow your portfolio without worrying about capital gains tax. That's why they're the #1 crypto IRA platform in America, with billions in tax-advantaged transactions. There are multiple ways to fund your account. You can make a contribution, transfer an existing IRA, or roll over an old 401k or employer plan. You'll get access to a wide range of digital assets, low fees, and 24/7 trading, all backed by secure, one-to-one asset ownership with institutional-grade custody. And if you have questions, ITrust Capital offers 100% US-based customer support with real people ready to help. Click the link, use code DOSE7, and get your $100 funding bonus today. Start building your crypto wealth, tax-advantaged, with ITrust Capital.
I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower. And I think that we're still holding our breath because we're in a period where the Fed isn't going to make an interest rate decision until September. So some of the key macro is kind of on hold. So I think markets are wait and see, but I'd say that pullbacks have been shallow. I can attest to it from our conversations with clients. We can see it measured in surveys like AAII, where there's stubborn bearishness net still. And then we did the rounds, Fundstrat did the rounds with a lot of our institutional clients the last 2 weeks. And I think folks are very cautious, which is actually good for stocks. They're cautious because, of course, markets have moved and our clients tend to be valuation sensitive. But I think adding to their frustration is that during that April downturn, many were selling their best names because they were trying to get defensive, and then they haven't fully reloaded yet. So I think that's why there's still room for stocks to go up. Really, at the core, any fundamental investor is going to use valuation as really one of their anchors. Is that the stock market had 6 stress tests in the last 5 years, from COVID to the bullwhip supply chain, to the fastest inflation cycle in history, to the fastest Fed hikes in history, then to the Trump tariffs, and then, of course, U.S. bombing nuclear facilities of Iran. Those are things that could cause catastrophes for earnings, but instead the S&P earnings have actually grown. So I think we're in the process of re-rating the S&P. So I actually think multiples will continue drifting higher.
Okay, so let's talk about other so-called knocks on the market. Valuation, obviously, one of them. They say there's too much speculation. You look at some of these stocks, meme stocks, low-quality stocks, cult stocks, and other things that have gone up. What's happening with these stocks? What's happening with some of this fervor that feels like it's in the market?
Well, I think the dearth of IPOs over the last 5 or 6 years has shrunk the number of stocks in the U.S. stock market. There's not even 5,000 listed stocks anymore. I think like a Circle is a good example of scarcity, because that was the best IPO really in 5 or 6 years, but it's a blue chip company. They are the biggest compliant issuer of stablecoins in the U.S. and it's growing prodigiously. So in a way, it makes sense that it went from, a $20 IPO to 200 today because it's scarce. It's just as scarce as a Palantir, but with a different market size. And I think that these quality names like a Figma represents that same scarcity because we actually have a shrinking number of stocks out there. There's a lot more privately held companies, but the public market's small. And then if you think about it, there's every year dividends are paid on the S&P. That's sitting on the sidelines. There's $7 trillion cash on the sidelines. People make income and they're saving 10%. If they don't buy stocks and they haven't been able to buy homes, this cash is piling up, and that's why it probably goes into the stock market. Okay. I think when people cite these numbers, and I've also heard Max Myers say that like 2 stocks are bigger than like Tokyo's entire stock market.
Max is going to love the shout out, by the way.
Yeah.
Anyway, please go ahead.
That we have to think about the earnings contribution. NVIDIA is producing incremental earnings at an incremental margin that tells you it's an incredibly scarce company. They're not making enough chips, and they are the center of the AI revolution. So I'm not surprised it's the biggest stock. I think from an earnings growth contribution, it's so big that those previous measurements aren't accurate. I think there's consumer preferences could be shifting. Because you remember, post-COVID, there was this boom in eating out and dining experiences. And we shouldn't say that that's a permanent change, and that's why you're seeing some of these. I don't think consumers are over-levered. To me, that's the sign of a peak in consumers because they can't amplify their spending. That's what the banks are going to tell you. And if you look at the Fed's debt service ratio, we're still below COVID level. Of course, at any moment there is, but really in aggregate, you can't get a levered consumer until you have a housing boom. So consumers might be on short-term credit, some of these being stressed, but that's very different than us actually peaking really from long-term credit borrowing in a binge. I think our year-end target is probably low because I think we could do 6,600 this month. I think this is the month.
This month?
Yeah, I think we're going to have a breakaway move in the S&P this month.
Even in what is a historically, not the best seasonal period for stocks, as we know. August is usually like a nothing burger, and then September is usually a reversal.
That's
negative.
Right. I think that's everyone's playbook, that August should be weak and September down. But precisely for that reason, with the economy being stronger than people realize, Bitcoin made a breakaway move on July 9th. It has led the S&P for the last 5 years by almost 1 month. So I think a breakaway upside move in the S&P is coming.
All right.
Yeah.
That's your call?
I would say that's our base case, yes.
Bears continue to sound the same alarms. The S&P is dangerously overvalued, speculation is out of control, and the market is far too concentrated in just a handful of megacap names. They argue valuations have stretched well beyond historical norms, that AI-driven hype has replaced fundamentals, and that if even 1 or 2 market leaders falter, the entire rally could collapse. Tom Lee pushes back on each of these claims. On valuations, he reminds investors that since 2019 the market has weathered 6 massive shocks: COVID lockdowns, supply chain breakdowns, record high inflation, the fastest Fed rate hikes in history, Trump-era tariffs, and ongoing geopolitical conflicts. Despite it all, S&P earnings kept climbing. That kind of resilience, Lee argues, doesn't justify sticking with yesterday's multiples. It warrants higher ones, and in his view, valuations still have room to rise.
Really, since 2020, the dips have been shallow unless we have structural problems. I would say it's a good sign that investors are cautious, which is what we're finding. And as Laura was mentioning, there's tariff concerns. People just want to get through and see what tariff impacts there are. But we also know that consumer expectations around inflation are cooling. I mean, it's prevalent in the UMich surveys, the Consumer Conference Board, and also the New York Fed. So I think the Fed correctly is being patient, but that's a catalyst because if we think there's cuts in the fall, that's good for stock.
Tom, what about a big, beautiful broadening this market? Does that come?
I think we're primed for that because the equal weighted S&P PE is 16.9 right now. It was almost 18 on the eve of COVID. So the market has gotten cheaper after facing all these stress, even at an all-time high. So is the case for stocks having better earnings performance there? Yes, if the Fed starts cutting and we're onshoring and the ISM's been below 50 for almost 30 months now, we haven't really seen a peak of a cycle until ISM breaks above 50 for a sustained period. That's earnings broadening. Yeah, and that's great. That would be great for industrials, financials, and, as I quietly say, small caps. we should think of it in sort of second order effects. The first is that the earnings growth of the median stock has actually been very good. So, and we saw it in earnings season because 83% are beating, and now the stacked earnings 2Q versus 2Q is over 12%. That's not just the Mag 7. But the second is that we know that the AI is progressing at a pace that it's delivering real benefits to companies. So companies are now going to see the benefits. I can't point to what it'll be, but it's probably margins. And so that's a story that should be broadening earnings performance.
Well, depending on the impact of tariffs.
Correct. And tariffs are things that are well telegraphed and socialized. And as soon as markets view it as one time, we will actually look through those.
Yeah, but not maybe from a price increase standpoint, but not necessarily a margin hit. As you're already hearing from some of the retailers, they're just trying to get their arms around exactly what all this is going to mean for their margins and their prices.
That's right. So, Scott, let's keep in mind tariffs are going to create winners and losers because the companies that imports are 10% of our economy, and the companies that are highly reliant on imports are going to have effects that they have to reprice their business and margins. But if someone said that should take down S&P earnings and the S&P 500, they're overlooking that the S&P is a broad set of companies.
Earnings going to hold up?
I mean, so far they have been, and I do think we're probably well positioned here. And let's not forget, we're looking at this concentration that's been happening in the markets. But when you look out about 12 months out, 12 months from now, in the past, I'm trying to say. But you're seeing things like financials, industrials, consumer discretionary. Those are all up over 25%. So yes, tech is doing well, but you have actually been seeing money go into other areas. And I do think at some point here, you are going to continue to see that. Again, especially interest rates coming down are going to be a big key of this, which is likely happening in the fall.
I mean, the earnings picture that Tom paints is right. Our markets desk passed a note out today referring to the results as stunning. Earnings performance up 13.2% versus the year ago quarter, almost 9% above earnings expectations. So there is data to support this picture. The question is, does it maintain itself?
And you're seeing that in guidance where companies have had really strong earnings, but they are being a little cautious moving forward, saying we don't really know how tariffs are going to impact us. We don't know how tariffs are going to impact the consumer. And I think that's where you are starting to see people aren't sure exactly how it's going to come out in the next couple of months, in the next couple of quarters here. But I am hopeful that we are going to continue to see these earnings coming in stronger than expectations. I think the bar is likely lowered because of the tariffs. And especially if you start to see all this come in towards the end of the year, I think it's just really setting up for a strong second half and a strong next couple quarters.
Tom Lee remains firmly bullish. His year-end S&P 500 target sits at 6,600, but he believes the market could reach that level as early as this month. August is usually quiet, September even worse, yet Lee sees a setup too powerful to ignore. He argues the real economy is running hotter than the headlines suggest. Bitcoin's breakout, which has reliably led equities by about a month, points to stocks being next in line. Meanwhile, cash pulled out during April's dip still sits on the sidelines, waiting to re-enter. And after surviving a pandemic, supply chain chaos, and surging inflation, the S&P has redefined what investors are willing to pay. Lee also sees AI's impact spreading far beyond chipmakers, while a Fed rate cut could ignite smaller names and overlooked sectors. His bullish case rests on 4 pillars: resilient earnings, sidelined cash ready to flow back in, valuations moving higher, and an eventual Fed pivot. For Lee, the rally isn't a future scenario, it's already underway. Do you buy into his outlook, or do you think he's missing key risk? Share your thoughts in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.